with the latest on the corporate front, all the market trends, expert opinion, and sound business advice. It is your unique window into the business world, direct from the heart of China.
Hello and welcome to Biz Today. I'm Zhao Yang in Beijing. According to the latest data, the U.S. economy shrank at an annual rate of 0.5% from January to March, being the first contraction in 3 years. Is raising fresh concerns regarding the strength of the U.S. consumers, the impact of high interest rates, and the state of the broader economy. Meanwhile, on the other side of the Pacific Ocean, China posted a stronger than expected 5.4% GDP growth in the first quarter. The country's economic engine is strong and gaining momentum. So what is really driving this divergence? And what are the main engines of the Chinese economy? What role do the trade dynamics, monetary policy, and geopolitical shifts play in shaping this economic narrative? For more on this, joined us on the line now are Dr. Zhou Mi, Senior Research Fellow with the Chinese Academy of International Trade and Economic Cooperation, Andy Mark, Senior Research Fellow at the Center for China and Globalization, and also Yan Liang, Professor of Economics, Willamette University. So Yan, let's start with you. The U.S. economy contracted by 0.5% in quarter one, while China grew 5.4%. So what do you think are the main drivers behind this divergence?
Well, I think for the United States, the first quarter contraction is quite expected. First of all, their federal government spending has gone down by 5.1% as a result of the DOGE, the Department of Government Efficiency, slashing government spending, cutting government contracts, and closing some of the government programs. So that reduces part of the demand that comes from the government spending. At the same time, in anticipation of the Liberation Day tariff, the imports in the first quarter has surged by 34.7%. So that is a drag on the economy. So those two main components of demand pretty much dropped significantly. Consumer spending slowed, even though it's still positive, but it slowed down to its weakest pace in over the 4 years. Investment remained still elevated, but the overall impact was overshadowed by the import surge. And that is why the US economy contracted in the first quarter. Compare that to China, in the first quarter, the fiscal government spending has gone up by 4.2%, and the export has surged by 6.9%. So these really help to boost, the demand side growth. And on top of that, we see very healthy industrial production. We're also seeing consumer sentiment being boosted by the trade-in program that was rolled out since the last quarter of 2024. So all of these help to maintain a healthy economic expansion in the first quarter in China.
And Andy, so looking at the U.S. economy first, what were the key factors behind the U.S. slowdown, do you think?
Well, I think that's a great question, Zhao Yang. I think most observers, including CEOs of major American companies, point to the policy uncertainty unleashed by the Trump administration, describing this as having a paralyzing effect. So I think, Yan Liang provided some excellent data, very comprehensive breakdown of the performance of the U.S. economy. So maybe I can focus a little bit more on the sentiment side. And here, again, business confidence is crucial for investment. And many CEOs have said, look, we can deal with a number, even a high number, when it comes to tariffs, or we can better deal with a high number. But it's the uncertainty, the back and forth, that really is causing a kind of paralysis. And I think this is highly detrimental, not only in the short term, but in the long term as well. So, this is kind of the area that I'm focusing more on in terms of an understanding of what is causing these macroeconomic macroeconomic performance recently and what the longer term implications might be.
And yeah, well, the U.S. GDP shrunk by 0.5% worse than the estimated. But we look at the Nasdaq and S&P are chasing record highs. So why is there such a big divergence on this?
Well, I think that's a great question. I think the stock market was pretty much boosted by the overconfidence in the tech sector, especially AI boom. We know that the Magnificent Seven, the seven high-tech companies that include Apple, Alphabet, and so on, accounted for now about 30% of the S&P 500 market capitalization. So with the confidence and with the enthusiasm in the AI sector, we're seeing that the market is very much exuberant, a lot of high valuations for these tech companies. But that said, I think there are concerns about whether or not this kind of boom is sustainable. When you look at the forward PE ratio, when you look at really how AI is being developed and also how it is being adopted in the economy, as well as the challenge and competition coming from China's much more cost-effective and open-sourced DeepSeek model. So I think there's a question about whether or not the stock market boom will sustain. But I think a more fundamental problem is that as you see that the U.S. stock market is quite detached from the real economy. The wealthiest 10% Americans own over 90% of the stock, the shares. So really, when you have a surging stock prices, that doesn't necessarily help to provide widespread benefits for average Americans. So I think you do see this sort of bifurcation of the economy. On the one hand, you're seeing these asset price inflation, but on the same time, the real economy seems to be really sluggish, and for many average American households, they're seeing rising costs of living. They're seeing uncertainty in terms of the job prospect. So I think it's quite interesting to really see the two sides of the economy.
And so Dr. Zhou Mi, the Federal Reserve Chairman Jerome Powell, said that businesses built inventories early to cushion the impact of tariffs. So how effective do you think this strategy has been? And could the short-term boost from the pre-tariff imports actually mask the long-term risks to supply chains and pricing stability?
I don't think that would be the best thing to deal with this uncertainty of the tariffs. I think that many companies are able to buy something for the inventories before they anticipate there will be a higher tariff, but that cannot last too long. There will be several reasons. The first one that all the companies have limited money and just the free money they can use to buy the inventory, because that also are taking a very important part of this money they can able to use. So they can buy something, but not just for a very long term. And the second, I think that the anticipation from the market is or more inflation. So when they are going to sell more things, it's not that easy for them to continue to use the original price, even if they want to control the price of doing that. And I think that third one is that we know that the supply chains are continuous, and most of these intermediate products or some of the raw materials they are using to build the machineries or other kind of things are not coming from United States. So they have to buy some things from other countries, as we can find that Donald Trump is trying to make more declaration on the higher tariffs, and like the 15, the 30, or even higher, they want to put the tariffs on the rest of the world. When he is trying to do more on the tariff things, it's not a very good signals that the market is trying to get. So compared with that, I think that many of the manufacturings are worrying about that. They have to raise their price, although they are not like to do that because they are very large competition domestically in the United States. They do not want to lose their market share, but they have to because the cost is going up. They have no choices. So I think that in the coming months, we are seeing that the inflation pressures will going up in the United States, the markets, the people will feel that.
And Yan, so what do you think about the Trump administration's tariff policy, their impacts on the U.S. consumer, inflation, and the broader economy?
Right. So I agree, with Dr. Zhou. I think that as Jay Powell was talking about, that even though we're not seeing, high inflation just yet, as you mentioned, the companies are stocking up, front loading the imports and inventory accumulation. Some companies are holding their prices because all the uncertainties, whether or not a trade deal will be reached, whether or not tariff will eventually go down. And let's not forget companies also, hike up their prices in the past few years. So that still leave them some healthy profit margin that they could sustain the current price for just a little bit longer. And finally, I think there are also some evasion of tariffs taking advantage of the loopholes. That's why the effective tariff rate right now in the US is about 10%, rather than 50%, which is the average headline tariff rate. But all of these are temporary. If the trade, the tariff is not being resolved, then it's very likely that countries are going to have higher tariffs when they export products to the United States, which means the U.S. importers will see higher costs, and eventually, they will have to pass these costs onto consumers by way of raising their prices, and so that means consumers would have to foot the bill. They would have to pay more, and according to some of the estimate, for example, the Yale University's estimates that the consumers could pay, $1,000 more, $3,000 more per year, due to these imported inflation. Right now, the Fed's the most recent data for the inflation is the headline inflation rates for 2.4% in May, which is a 0.1% increase month to month. So again, that's not a desirable direction that the Fed would like to see the inflation rate to travel. So again, right now, I think Powell is very concerned that inflation could start to rise in the summer, and that's why it's unlikely that we're going to see the Fed to cut the rate in July. Now, I think many estimate that the Fed is going to cut only one time this year. Either, some estimate is in September, others would say is at the end, of the year, right around December. So it remains to be seen. But I think, with the inflationary pressure and with the Fed holding up the rate, I think that is not conducive to the U.S. economy. Not to mention, with all the supply chain that could be disrupted, as well as the business sentiment, as Andy talked about earlier, with these on and off tariff, I think it really disrupts the businesses' planning when it comes to investment decisions, hiring decisions, and so on and so forth.
And Yan, so talking about the fiscal policy, we know the Trump administration's one big, beautiful bill. So tell us what's the details of it and how will that impact the U.S. economy?
Well, so the bill is pretty much to extend Trump's 2018 the Tax Cut and Job Act. And pretty much this will give a lot of tax benefits to the corporations and also to wealthy individuals. I think the most recent estimate is that about top 20%, the income earners will get 60% of the tax cut benefits. But in order to pay for, according to the U.S. Congress, to pay for those tax cuts, they would also have to cut certain spendings, and so the spending cuts will mostly come from healthcare and also food stamp, and so that means it's going to be a very regressive kinds of tax cuts. In other words, about 16 million of Americans could become uninsured in the next 10 years. And also many people would be affected by, the added administrative burden of applying for, food stamp and also for Medicaid. So I think this is going to, create a lot more widening, inequality in the U.S. economy, and that could, of course, dampen, consumer safety, security, and also confidence. Last but not the least, I think the most recent estimate is that this bill is going to increase the federal government debt by $2.4 trillion in the primary account in 10 years, or $3 trillion with the total budget deficit. So I think, many would worry how this is going to affect the federal government's interest expenses, because that would really eat up a lot of fiscal space. And so that may, again, prompt even further cuts to some of the important, public services and safety net to the U.S. economy. But that said, I think, the bill also increase in, national defense and also in the ICE, border control funds. So again, I think there are a lot of regressivity in this bill.
And Andy, so what do you think about the Trump administration's fiscal policy? Do you think it will lead to serious government debt issue for the United States?
Well, I think certainly there is growing concern about the sustainability of the American government's debt. But I think I want to concentrate a little bit on the equity aspect of this because, again, with corporate tax cuts, the extension of the first Trump administration's tax cuts, that this is believed certainly by the Trump administration. And I just want to go back a bit, Zhao Yang, if I may, to about the U.S. equity markets. So just briefly, so the S&P has been up about 66 times since 1971 with the so-called Nixon shock. And about half of that is due to inflation. So I think we can expect, again, the markets to keep moving higher, unless there's some exogenous factor. And if we look at the fiscal policies taken by the Trump administration, again, I think they're largely intended to boost corporate America, to boost the stock markets. And clearly, I think Yan Liang makes a good point that some people in the U.S. are paying a price. But the belief is that a rising tide will lift all boats, and that this ultimately will benefit the country. And I think this is the big question mark, isn't it? Whether this, in fact, really is the case.
Mm-hmm. And Dr. Zhou Mi, actually, the U.S. economy shrank by 0.5% in Q1. While on the other side of the Pacific, China posted a 5.4% GDP growth. So how do you explain that?
Well, China's companies are really very active in finding, trying to fight against the different kind of uncertainty in the past decades. So this time, I think the many Chinese companies are already anticipated that there will be a very big impact on the, tariffs on the market entrance to the United States market. So they have prepared that for, at least several years. So these kind of ideas are when we are looking at the performance of China's import and export in the previous decades, we can find that they are very resilient. They are not just trying to compete with the other competitors in the world by the prices, but also are trying to make a better or a higher quality products and trying to improve their structure of the trade. So they have put a lot of strength in doing the research and development. That is the reason I believe that even we see that the tariff has changed the scenarios of competing in the global market. I think the Chinese companies are doing pretty well in dealing with this uncertainty. But I will also say that they are affected a lot by this protectionism and unilateralism. So they are going to understand the philosophy of these tariffs and trying to cope with this situation with their partners from the United States and also from the rest of the world. So if you're looking at the performance of China and United States for the first quarter, I think that the differences are huge. That there are quite a lot of factors, as both experts have mentioned, are coming from the people's anticipation and expectation. So for Chinese market, we are providing certainties and we are trying to make the economies to grow continuously and sustainably. So we are going to fix some of these weak point of Chinese economy and trying to have a better exploration about the potential of development from the coastal areas to the central and western areas of China. We are trying to connect with our trading partners with a better and more resilient and even stronger relations by the free trade agreements or other mechanism. But for the United States, they are destroying these relations with their trading partners. They are building walls. They are putting more restrictions on the bilateral trade and investment. They are trying to give some messages that U.S. have to win this competition in the world, and that is in the cost of other countries' benefits. So if you're looking at the G7, like we can find that from the fiscal policies continuously, and United States has put it in the position of exemption for the so-called the Pillar 2. So this means that the commitments that the previous government has made will not be accepted or will not be obeyed by this administration. That is disaster, not for just this administration, but for the future, for the trust of United States. And I think that is the reason why the people are going to just make even more short-term decisions in doing businesses with U.S. economy. When they are going to do the businesses with Chinese economy, they are thinking in the middle term and even longer term. So this makes the differences. So the impact of these differences by both governments are really affecting the people's decisions, and that is a very important reason why we see the differences of both countries in the first quarter.
So, Yan, do you agree with Dr. Zhou Mi? And what do you think about the Chinese economic trajectory so far this year?
Right. So I agree. I think the U.S. has committed under Donald Trump a lot of policy missteps, and not only it really undermined the U.S. own economy, as we saw that the main number, the U.S.'s exports actually has fallen by 5.2%, and their trade deficit actually expanded by 11%. So this is complete a opposite outcome than what the policy, the tariff policy, tries to accomplish. So the economy is really going the backwards. And so I think that really shows the policy's ineffectiveness. Not to mention, I think the long-term, effect, as Dr. Zhou Mi elaborated, is the loss of credibility of the U.S. administration, and also their own sort of retreat from the multilateral system that has actually been pioneered by the United States and benefited the U.S., especially corporations. But now I think they're walking back from their previous policies. And so that kind of policy uncertainty is not only going to undermine the U.S.'s own, investment and consumption confidence, but also really undermine the U.S.'s credibility and its partnership with the rest of the world. Whereas I think for China, the policymakers are always taking a long-term view and have very strategic thinking when it comes to, for example, boost technological innovations and have the high quality growth driven by innovations and high quality productive forces. And they have been rolling out policies consistently to achieve that goal. Domestically, they're supporting technological developments and now also pivot towards consumption, providing fiscal, monetary, and direct support to consumption. But also when it comes to external, economy, China has been engaging in the so-called high-quality opening, so attracting foreign investments, encouraging the Chinese companies to go out, and also build a lot of trading relationships with many countries in the world. Not to mention the BRI, the Belt and Road Initiative, that is based on extended consultation, joint contributions, and shared benefits. So I think all of these, with the three major initiatives, China is really integrated into the global economy, in a gradual and also mutual beneficial way, and partner with, many global South countries. So I think, the policy trajectories are very, very different. And so I think to a great extent, that would also affect the development paths or growth paths of the two countries.
And Dr. Zhou Mi, as Yan mentioned, China has been implementing stronger and more targeted measures to boost consumption. So how effective are they? How do you view the new consumption model? And what about the potential of services sector consumption in China?
Yeah, as you mentioned, that services are playing an even more important part in this consumption mode. So we are creating better service providers. They can provide the services in the digital forms, in a lot of new forms to the possible consumers. So we are trying to give more support for the consumers. So the consumers are expected to have a better choices of having more choices on the jobs, on the occupations to get more income. So we hope that we can do more to support both sides of the supply and demand side. So I think that there are so many new areas we can notice that, like for the some of these new products in the consumption mode, Labubu, and also there are several very new kind of innovative ways for people to enjoy. So I think that the conception is not just the short-term decisions or activities. We want to put it more resilient and more sustainable, and that really need a lot of efforts.
So several multinational investment banks like JP Morgan, Goldman Sachs, they have all raised their forecast for China's GDP this year. And foreign financial institutions also upbeat on China's capital market. So how do you explain that?
Well, first of all, I think the optimism about the Chinese economy is well warranted. If we look at the most recent number, the retail sales in May has gone up by 6.4%, which accelerated from the first 5 months. So I think that shows, the consumer sentiment is recovering, and especially the trade-in program has been very effective. And as Dr. Zhou Mi also said, that there are many policies are rolling out to support consumption of services. So all of this could provide a good prospect for the internal, demand-driven economy. Industrial output production, of course, has remained strong at 5.8% growth in May. High-tech investment, I think, and manufacturing are especially important. So I think just the internal demand, on the internal demand side, we're seeing, the economy is picking up. Another really important driving force, and I think that is much more long-term, is China's technological development. I think, February's DeepSeek shock will continue on as China builds more momentum in various sectors. It's not just the AI, but the entire ecosystem, low altitude economy, the blue economy, green economy, silver economy. So I think, you're seeing a lot of technological innovations and developments, and also adoptions of these various technologies in the broad economy, robotics, EVs, and green energies. So I think all of these would help to provide the impetus for the long-term growth in China.
Well, we're speaking with Yan Liang, Professor of Economics, Willamette University, Dr. Zhou Mi with the Chinese Academy of International Trade and Economic Cooperation, and also Andy Mark, Senior Research Fellow at the Center for China and Globalization. And that's all the time we have for this edition of Biz Today. To listen to this episode again or to find more previous episodes, you can download our podcast by searching for Biz Today. I'm Zhao Yang in Beijing. Thank you so much for listening.